stop watching Tesla's stock price. Stop focusing on delivery numbers. The real story is happening in Tesla's supply chain, where a metal most investors ignore is creating a crisis that could reshape the entire automotive industry. While Wall Street debates Tesla's margins and Elon Musk's latest announcements, institutional procurement teams are quietly facing a mathematical impossibility. Every Tesla Model Y requires approximately 22 grams of silver. Every Model S needs 24 grams. When you scale that across Tesla's 2.2 million unit production target for 2026, the numbers reveal a supply chain vulnerability that most market participants completely misunderstand. Tesla consumes roughly 51 million ounces of silver annually. That places them among the top 10 industrial silver consumers globally, competing directly with solar panel manufacturers, smartphone producers, and military contractors for the same finite supply. But here's what the market has not calculated. If Tesla hits their projected 5 million units by 2030, their silver requirement jumps to 115 million ounces annually. That's 14% of total global mine production. For context, that's more silver than most countries produce in a year. According to risk assessments from automotive supply chain analysts, Tesla's procurement strategy shows critical vulnerabilities. Unlike traditional automakers who locked in multi-year metal supply contracts decades ago, Tesla's rapid scaling has left them exposed to spot market volatility. Internal sourcing documents suggest Tesla pays premium pricing for guaranteed delivery, sometimes 20 to 30% above benchmark rates. This creates a cascading problem across the entire electric vehicle complex. When Tesla bids aggressively for silver supply, it drives up acquisition costs for every other EV manufacturer. BYD in China, Volkswagen in Germany, General Motors domestically, they're all competing for the same shrinking pool of available metal. The mathematics become more concerning when you examine the broader industry transition. Traditional internal combustion engines use approximately 2 grams of silver per vehicle, primarily in electrical contacts and control systems. Electric vehicles require 10 to 12 times that amount due to battery management systems, power electronics, charging infrastructure, and thermal management components. McKinsey's automotive transition models project global EV production reaching 43 million units by 2030. At current silver intensity ratios, that represents aggregate industry demand of approximately 1 billion ounces annually. Total global silver mine production is 800 million ounces. The gap is 200 million ounces, or 25% of required supply. This supply-demand imbalance is already creating procurement stress within Tesla's operations. Supply chain intelligence indicates Tesla has moved from just-in-time inventory management to strategic stockpiling for critical components. Industry sources suggest Tesla has established forward purchase agreements extending 18 to 24 months, significantly longer than their historical 3 to 6 month procurement cycles. But Tesla's silver challenge extends beyond simple supply shortage. The company faces what institutional analysts term supply chain concentration risk. Approximately 65% of global silver refining capacity is located in China. Tesla's Shanghai Gigafactory depends heavily on Chinese refined silver for local production. Any disruption to Chinese export policies, trade tensions, or geopolitical instability directly threatens Tesla's largest manufacturing facility. Recent regulatory changes in China's export licensing framework have already impacted Tesla's procurement flexibility. Chinese refiners now face stricter export quotas and enhanced documentation requirements. Tesla's Shanghai operations report delivery delays and increased procurement costs as Chinese silver increasingly serves domestic manufacturers first. This dynamic creates strategic advantage for Chinese EV competitors. BYD, NIO, and XPeng benefit from preferential access to Chinese refined silver, while Tesla faces export restrictions and premium pricing. The competitive implications extend beyond cost structure to production reliability and scaling capability. Tesla's response reveals the company's assessment of supply chain vulnerability. SEC filings indicate Tesla has diversified silver sourcing across multiple geographic regions, established direct relationships with mining companies, and invested in recycling infrastructure to recover silver from battery manufacturing waste streams. More significantly, Tesla's materials science teams are reportedly exploring silver reduction technologies. Engineering specifications suggest potential design modifications that could reduce per-vehicle silver content by 15 to 20% without compromising performance. However, these modifications require extensive testing, regulatory approval, and manufacturing retooling, processes that typically span 2 to 3 years. The implications extend beyond Tesla to the broader metals complex. Silver's dual nature as both an industrial metal and monetary asset creates unique market dynamics. When industrial demand from EV manufacturers intersects with investment demand during monetary uncertainty, price volatility intensifies dramatically. Institutional positioning data indicates hedge funds and commodity trading advisors are increasingly modeling silver as a structural supply deficit play rather than a cyclical trade. When industrial demand is largely price inelastic, Tesla cannot simply reduce silver usage without redesigning vehicles. Traditional economic relationships break down. This creates systemic risk within automotive financing structures. Auto loans, lease agreements, and manufacturer financing all assume predictable production costs and stable supply chains. If silver procurement costs continue escalating, or if supply disruptions force production delays, the financial assumptions underlying automotive credit markets require reassessment. Central bank policymakers are also monitoring these dynamics. The Federal Reserve's industrial production indices increasingly weight EV manufacturing capacity as a measure of economic resilience and technological competitiveness. Supply chain disruptions in critical EV components like silver could influence monetary policy decisions, particularly regarding strategic material reserves and trade relationships. The timeline for resolution appears extended. Mining companies report that developing new silver production capacity requires 7 to 10 years from discovery to commercial operation. Recycling infrastructure, while growing, cannot offset projected demand increases within the current decade. Alternative materials research shows promise but faces similar development timelines. Tesla's silver crisis represents a microcosm of broader resource constraints facing the clean energy transition. The same supply-demand imbalances affecting Tesla are emerging across lithium, cobalt, rare earth elements, and other critical materials essential for renewable technology. Market intelligence suggests institutional investors are positioning for what they term the commodities supercycle of the energy transition. This thesis holds that the raw material requirements for electrification will create sustained upward pressure on critical metal prices, fundamentally altering industrial cost structures and competitive dynamics. For Tesla specifically, the Silver Challenge may prove to be a defining test of the company's operational sophistication and strategic planning capabilities. Successfully navigating this supply chain constraint while maintaining production growth and cost competitiveness could establish Tesla as a supply chain leader. Failure could create opening for competitors better positioned on critical material access. The resolution of Tesla's silver crisis will likely establish precedents for how innovative technology companies manage resource constraints in an era of increasing material scarcity. Whether through technological innovation, supply chain restructuring, or strategic vertical integration, Tesla's approach will influence industry-wide responses to similar challenges. Watch how Tesla's quarterly reports address metals procurement costs. Watch for announcements regarding supply chain partnerships or materials technology developments. The company that revolutionized automotive technology may need to revolutionize automotive supply chains to sustain that revolution. But Tesla's silver dependency creates a more immediate financial vulnerability that Wall Street hasn't fully priced in. Current Tesla valuation models assume stable input costs and predictable scaling economics. If silver prices rise from current levels around $80 per ounce to $120, a 50% increase that supply-demand fundamentals suggest is probable. Tesla is per vehicle material costs increase by approximately $14. That may sound modest until you scale it across Tesla's production targets. At 2.2 million units annually, a 50% silver price increase represents $31 million in additional annual costs. At 5 million units by 2030, that impact grows to $70 million annually. For a company where investors scrutinize every basis point of margin compression, this represents material earnings risk that current analyst models don't adequately capture. More concerning for Tesla's competitive positioning is the asymmetric impact across global EV manufacturers. Chinese competitors like BYD benefit from domestic silver refining capacity and preferential allocation policies. European manufacturers maintain legacy relationships with Swiss and German precious metal suppliers established over decades. Tesla, despite its innovation leadership, operates from a position of supply chain weakness in critical materials procurement. This competitive dynamic is already manifesting in production scheduling decisions. Industry intelligence indicates Tesla has modified certain production runs to prioritize higher margin vehicles when silver procurement costs spike. The company's recent emphasis on the Cybertruck and Tesla semi-vehicles with higher per unit profitability may reflect strategic adaptation to rising materials costs rather than pure market opportunity. The silver constraint also illuminates a broader strategic miscalculation within the technology sector. Silicon Valley's approach to scaling typically assumes that increasing production volumes drive unit costs lower through economies of scale. This model works for software and digital services, where marginal costs approach zero. It fails when physical production depends on finite geological resources with inelastic supply curves. Tesla's management has acknowledged this challenge indirectly through recent statements about vertical integration and supply chain control. Elon Musk's comments about potentially acquiring mining assets, previously dismissed as offhand remarks, now appear strategically motivated by Tesla's exposure to commodity market volatility. The company's energy storage division faces even more acute silver requirements. Tesla's Megapack utility-scale batteries use substantially more silver per unit than automotive applications due to higher current loads and thermal management requirements. As Tesla expands into grid-scale storage, a market the company projects could exceed automotive revenues within a decade, silver procurement becomes exponentially more challenging. Institutional analysis suggests Tesla may face a binary outcome scenario within the next 18 months. Either the company successfully secures long-term silver supply through strategic partnerships, vertical integration, or technological alternatives, or it faces production constraints that limit scaling ambitions and compromise competitive positioning. Early indicators of Tesla's strategic direction include recent patent filings related to silver recovery from manufacturing waste, increased engagement with South American mining companies, and expanded relationships with precious metals recycling firms. These moves suggest Tesla's leadership recognizes the materiality of the silver challenge and is actively developing responses. However, the timeline for effective solutions extends beyond Tesla's immediate production commitments. Securing mining partnerships requires extensive due diligence, environmental permitting, and capital allocation decisions that span multiple years. Developing silver reduction technologies demands rigorous testing protocols and regulatory approval processes. Even recycling infrastructure requires substantial lead times for facility construction and operational scaling. This creates what risk managers term a valley of vulnerability, where Tesla's silver requirements continue escalating while supply chain solutions remain under development. During this transition period, Tesla faces elevated procurement costs, potential supply disruptions, and intensified competition for available metal supplies. The implications extend beyond operational challenges to Tesla's broader investment thesis. Growth investors have valued Tesla primarily on scaling potential and market share expansion within the EV transition. If silver constraints limit Tesla's ability to scale production at projected rates, the fundamental assumptions underlying Tesla's premium valuation require reassessment. Conversely, if Tesla successfully navigates the silver constraint through innovation or strategic positioning, it establishes durable competitive advantages that could justify even higher valuations. Companies that control critical supply chains and resource-constrained industries often achieve premium multiples relative to competitors, dependent on spot market procurement. The Tesla silver story represents a case study in how geological realities intersect with technological ambitions. The same material scarcity affecting silver exists across lithium, rare earth elements, and other critical inputs essential for clean energy infrastructure. Tesla's approach to solving the silver challenge may establish templates for addressing broader resource constraints within the energy transition. Financial markets are beginning to recognize these dynamics through increased allocation to critical materials, focused investment strategies. Commodity-linked assets, mining company equities, and materials technology ventures are attracting capital from investors, positioning for what they anticipate will be sustained materials inflation throughout the electrification process. Central banks are also adapting policy frameworks to account for supply chain vulnerabilities in strategic industries. The Federal Reserve's recent emphasis on supply chain resilience within monetary policy communications reflects recognition that resource constraints could limit economic growth potential and influence inflation dynamics in ways traditional economic models do not capture. The ultimate resolution of Tesla's silver crisis will likely establish new paradigms for how technology companies manage resource dependencies in an era of increasing material scarcity. Whether through technological innovation, supply chain restructuring, or strategic vertical integration, Tesla's response will influence industry-wide approaches to similar challenges across the clean energy complex. Watch quarterly earnings. Calls for Tesla's materials cost guidance. Monitor supply chain partnership announcements and technology development initiatives. Track regulatory filings for potential mining industry investments or strategic material inventory reporting. The silver story is bigger than one company or one metal. It's about the hidden constraints that determine which technologies succeed and which companies control the transition to the new economy. Subscribe for continued analysis of the structural forces reshaping global markets.